just another quick audio visual check. If you can just confirm in the right-hand side of your screen in the chat bar that you can see and hear correctly. Once I see the yeses coming through, I'll get started in a few moments. Won't be a second. Okay, I've got a few of you coming through saying that you can see and hear correctly. We've had a few technical issues, which is always the way. Now, yes, we can see the mind-boggling capital growth slide there in front of you. Let's jump right in. I'm sorry we've had a couple of minutes delay. We've got a very special guest joining us tonight who's going to give us some amazing insight and unique insight into property in Sydney, what is happening in the investment space, but probably also more importantly, what types of properties are still offering the potential and the ease to get into a successful tenancy, potentially, and not pose ongoing maintenance issues or a bit of a misfit with what tenants are demanding. So our special guest tonight will be able to help us in looking and having a bit of insight into what is happening in growth in Sydney, but also what properties are going to be hitting the mark in terms of delivering us ongoing nice, strong yields and rental growth. So lots to take in. We will be doing a capital growth analysis, a street-by-street analysis of Sydney, and our special guest tonight will also be able to give some local insight there, which is going to be very beneficial. Let's jump right in. There's plenty of you on the line, so thank you for taking the time out tonight and joining us. I hope you do pick things up. It will be a very dynamic and interactive session, so do feel free to ask questions at any time. If they are relevant, I will jump in and answer them directly. If they are probably something that can be gathered up towards the end, we will get to that at a Q&A session at the end of this evening. So we're aiming for about 45, 50 minutes. Special guests will stick around and answer any questions directly. But yeah, keep the questions coming through. It'll be great to work back and forth with you. I did just share a link into the chat bar, which is a YouTube link. We can view this telecast directly in YouTube, which may improve your quality and the stream quality of the content. So if there's any issues in terms of fuzziness or buffering or audio problems, jump across to that link over in YouTube. Otherwise, potentially refresh your browser, press the reconnect button down the bottom there, and that might resync things. Also, it's worth making sure there's nothing else that's sharing the connection. So other videos that might be slowing things down, make sure they're closed and the connection is pure for the content to be nice and clear. So let's jump right in. For those of you that don't know a little bit about me, I'm the founder of ripehouse.com.au, which is a research and content education portal for property investors. So I've been investing since early 2000s. I'm probably now across Australia. Was able to move away from full-time employment in 2012 on the back of my property portfolio. But I would classify myself as a DIY property investor. And by that, I mean, I suppose I prefer to learn and embrace the journey and conversations with other people and really own the process of acquiring property, as opposed to going out and paying for a buyer's agent or buying off the plan, or less active. When I like to be able to control things. That's me personally, but Right House has been developed on the back of my need to research and find and invest in property. And we've now formed a large group of investors that are like-minded, trying to do similar things and helping each other on the back of good research and good information and education. So that's what it's all about. A little bit about me. I've got an IT and development background, and that was my day job. And I enjoy and try and keep fit playing basketball. Not very well usually, but it's good to have a bit of a sport. And I have a couple of young kids with my wife, so we kept very busy generally. Our special guest tonight, without further ado, I might get you to unmute your microphone there, Edwin, is Edwin Almeida he's the licensee and managing partner of Just Think Real Estate, based there in Sydney. He specialises personally in property management, but I've had ongoing unique conversations with Edwin about how he digs a little bit deeper to make sure he's putting all the properties that are renting and purchased on behalf or with people who are would manage that property through him, are really hitting the mark in terms of low maintenance, good quality build, good quality property that's going to hit the tenant demand in the streets that they are purchasing it. So he is very knowledgeable. He actually he presents and puts content together for us on the Frontier Investor, which is our content portal, and it's great to have Edwin on the line tonight to share a little bit of his insight and expertise. So thanks for joining us, Edwin.
Well, thank you very much for having me in your program and live throughout Australia, possibly even the world.
Sorry, mate. I just had to change my microphone over there, so I didn't catch the beginning of that, but I caught the end of it in terms of. I'm sure there's going to be a lot of questions coming through tonight. Get involved. You've got someone on the line who can really help understanding a property investment space and property management space. So we've got a unique resource to be able to tap into. So a little bit about, do you follow NRL, Edwin, AFL, rugby league, rugby union?
None of the above, unfortunately, but I do love to watch the competition. I do love to watch the any type of sport.
Yes.
I've actually started. I've got myself back into the ring with boxing and
wow.
now doing a bit of kickboxing.
So you're going to keep you fit, very fit.
Trying to, because otherwise spending 8 hours, 9 hours in the office and driving around all around, Sydney, looking at development sites, looking at property, yes. Looking at any potential issues with our owners' properties or trying to avoid issues with the due diligence that we do. Obviously, unfortunately, just keeps us either in the car or in the office. So I've had to take on a bit of sport.
Yeah, no, very good. I was only asking that question because we're right in the midst of AFL and NRL finals at the moment, and everyone down here in Tassie is going crazy for AFL, which we're all footy mad. So I was just trying to tap into the pulse up there in Sydney. Let's jump right in. As I say, I want to keep things quite conversational. If you've got any questions for myself or Edwin, do jump in. If they are relevant to what we're speaking of at that moment, we'll do our best to really answer. Otherwise, we'll group them together at the end. Let's just find out a little bit about yourself. So I'm down here in Tassie. Our office is based here. I'm born and bred, but I have lived in Sydney for 6 years and we've migrated back. I'd love to hear about you guys. Where are you based? Are you currently renting, owner, occupier, with mortgage, without? Are you potentially rent vesting is the term that's sort of coined at the moment, where that is you're still renting but buying and investing in property. Just tell us a little bit about where you're based and where you might have properties. It'd be great to get some insight. I guess that's probably a little bit of there's a little bit of a delay in the chat coming through. So it was our sixth property that we purchased that we actually were able to live in and as an owner occupier. So we went down the route as a young couple where we did start buying investment properties, renting them, good yields. We were able to then buy where we wanted to live and start a family. So we went down that track. Let me see the. Okay, I'll let the comments coming through with a little bit of delay. Are you comfortable talking about where you've come from in the property space, Edwin, or?
Look, definitely more than happy to.
Yes. We've got Gunnerwin from Sydney. Where's Edwin's based? Obviously specialising in it. Yep, Scott's living in. So this is a delay, by the way, in the chat coming through. So New South Wales living and with rents, looking to purchase. John's renting in Sydney, trying to invest elsewhere in New South Wales. Nice to meet you, Gunnerwin. We're well, thanks. Hope you're well as well. Yeah. How about yourself, Edwin? Are you looking at currently investing at the moment, or obviously focusing on the Sydney space?
Well, in relation to Sydney, I'll tell you what my partner and myself have just recently done. We've sold our principal place of residence.
Beautiful. Yep.
We've
at the top of the market.
We've cashed out.
Yes.
We looked at some regional property where I've been studying the markets there for the last 3 years, and the balance is waiting to get us back into the Sydney market. when the changes that I strongly believe will happen in the next 6 to 12 months happen, and our strategy will be to move back into the older style properties. When I say older style properties, that's apartments
Yes.
that were built in the 70s.
Gotcha. Yep. Usually with low body corporate costs, usually pretty good bones.
Yes, and what I believe we're going to see is I believe that we're going to see a big exodus of tenants from these older units, and they'll be occupying the new high-rise apartments that are being built all over Sydney.
Okay. Yep. Okay. It might be worth going into that in a little bit more detail when we jump into some suburbs a little bit later on. It'd be good to get that sort of insight about what you're seeing with the new builds and how people might be moving in terms of demographic changes or how people live, the shifts in lifestyle and what people are doing. It'll be interesting to get that deeper dive. But let's leave it right there. A lot of you coming through. It seems the vast majority based in Sydney. If anyone that's not in Sydney, please shout out. It'd be good to. We generally have about 60 or 70% of people online in Sydney. It seems you guys are really looking to invest across the country at the moment, and obviously in Sydney. But it'd be great to get the variety or a bit of an understanding of that. So let's keep moving along. What we're going to be talking about is research. The Ripe House platform is research-based. It'd be great to get the human touch from Edwin tonight. It's just based on common sense research, common sense application of buyer behaviour and how people operate and why they might move to certain areas and drive up growth. So that's what it's all going to be coming back to. And we are going to be doing some real life case studies, so breaking down some suburbs and then particularly individual streets and properties that we can target for growth. And then with Edwin's touch on it, potentially suited to tenant demand, changes in tenant dynamic, and also presenting us with low maintenance and good opportunity to have a nice carefree tenancy, which is what it's all about. But we are talking about, and I try and break this down, and these sessions are really good in doing this. This is what we try and relate things back to in finding capital growth. So what we're doing tonight, the point does need to be made that we are focusing on Sydney because I have known a lot of you are based in Sydney. I've wanted to get Edwin on and share his unique insights for a while, and he's based in Sydney. That's his area of expertise. So we are tonight starting with the catchment area or the area of focus as defined. Okay, so generally the Ripe House system and platform is optimized to increase your catchment area, so your area of interest to be the whole country. When you do that, you are finding the individual segments in the country that are at the optimum buying opportunity, or at the growth phase of the property clock. That could be anywhere. When you open yourself out to the country, you'll find that number one opportunity. Getting the local government area right. Once you find that local government area that is delivering or has the potential for outstanding growth, making sure you're positioning yourself in the suburbs that are going to lead the local government area forward. So I'll be going back and forth on that quite a bit tonight. Making sure you get the street right. So everyone will be able to give a lot of insight into the whys of why tenants move into certain blocks and why they might move into certain parts of a suburb. But just have, I suppose, think about things from your perspective where you live. There's definitely streets that you would stay away from if you're moving to the area, streets that you know that are going ahead and people seem to be just gravitating towards. They are the streets that generally deliver us above average growth, and we've got to try and develop a methodology for finding those. So that's what I'll be taking you guys through tonight. This methodology to get the research right at each of these layers with a little bit of the human touch on it. How to find the exact property that's going to really hit the mark and deliver the growth, and how to potentially negotiate and buy at or below value. That's the whole system. I think our research and acquisition of property needs to be holistic. It needs to start with the country and end up at an individual property. But each layer of our funnel heading down towards that individual property needs to amplify our upside. So I'll be taking through that. It's just a reference to how I'll be detailing our individual case studies tonight. I want to make that really perfectly clear. Let's just take a really quick moment to just talk about what I mean by increasing the catchment area. It's about looking across the country for the absolute number one growth potential for what you're trying to do at this moment. So if you really have a strong renovate for profit strategy, you might be focusing on certain suburbs or areas that would be very different to a cash flow based strategy or a growth strategy. So we are talking about growth in terms of organic growth. It's not, the chances are that number one area are probably not going to be around the corner. Having said that, if it is around the corner, you might have the opportunity to do a lot of value add. You might know the market as a local. You might be able to. So that's probably, tonight we are going to be talking about Sydney and limiting our search to the Sydney area. But that needs to be, the point needs to be made that you might be giving up or have opportunity cost in missing out on opportunity in other local government areas or states across the country. So when you don't increase, so we haven't increased our catchment area outside of Sydney, you might be missing out on opportunity. That's just trying to clarify that point. How do you increase your catchment area? Just very generally, you've got to improve your comfort level with research and data and tools to be able to research and acquire anywhere. Going back to when I first started investing in property, it was early 2000s. It was very difficult to get any type of normalized information across the country. You know, you had localized growth information. You could obviously talk with agents and potentially even other investors, but getting yield information, it was really difficult. Things are improving. Information is allowing us to really step up our game, and that's what it's all about. I just want to probably clarify where we are at in the nation. You've probably, a lot of you on the line have heard about property clocks and what they are. We are all about tying together current and live information to form any of our insights. So property clock is only one mechanism for gauging a market, but at a state level, a property clock is too general. So Queensland is at 8 to 10 o'clock on the property clock. Based on all of our data, we have a page within Ripehouse where we can see live property clocks to the day. But at a state level, that property clock's too general because you've got regional or coastal Queensland going in one direction while you've got inner city Brisbane going in another. And when you dilute that down to a state level recommendation, you're not really getting that much meaning. So even just to speak with what our research is showing in New South Wales at the moment, you've got some really strong regional centres, the Alburys, the Dubbos of the world, that are doing really good things and are probably at the beginning part of their growth cycle, or they have been growing for some time, but they have still very strong indications of future growth. Or you have the mid to upper tier of Sydney that's definitely gone into the slowdown phase, or you've still got some steam left in the tank in the mid to lower areas of Brisbane, of Sydney. So we'll get into a little bit more nitty gritty when we see the local government areas stacked against each other. But I just wanted to make the point at this level that state level information is usually too general and it's not that helpful in helping us make a decision. We need to be making, and all of the research that we do, the tools that we access need to be looked at in terms of live data. If you're looking at a report that's focusing on last quarter of last year information or last quarter information, it takes 6 weeks to gather and collate that information and put, and then another 2 or 3 weeks to put the report together. You are acting on information that is out of date. We need to have a system, and the system needs to be able to look at data as of today and make decisions on that. Because if you're positioning yourself for outstanding growth in the number one growth market, you want to get there before the masses. You want to get there before the large groups of buyers are looking at that market, and position yourself just before it and not necessarily hold a property for a period of time without any growth. So it's about knowing when that window is open and when it's closed and putting yourself right at the optimum position. So I'll talk a little bit more about that later on. Timing is everything. What we're talking about now is hockey stick growth. I might pause things there and we can jump in the tools, and this would be great to start getting inside Edwin's head about what he is seeing in Sydney. This is the homepage for Ripehouse. This is where you can launch in. We've got a dashboard page, which is where I suppose you navigate the site. It's where the magic happens. You've got 4 areas of functionality. You've got the Learning Centre. The Frontier Investor here is our unique content portal. It's for investors, by investors. Edwin's just released an awesome article today about the big property investment appetite. I guess the point needs to be made. The Frontier Investor is a mechanism for experts in the industry to contribute high value content without any sales pitch, marketing pitch, or ads, whatever, in any way, shape, or form on the site. And to be a contributor on the Frontier Investor, I guess we've formed relationships with over the years, and they are people who have the customer and value for the customer first and foremost. So yeah, check the Frontier Investor out. All the contents, generally every day we have new articles, some really interesting stuff, and it's all for investors, by investors. You get to that via your dashboard page. We've got the articles coming through on a feed there. You've got other investors using the platform, and you can see news items from what they are doing with the research. But you've got 5 layers of research. So if you can think back to how you stack your research in state into LGA, into suburb, into street, into property, if you do that right, you deliver outstanding growth results. And we have the 5 layers of our research here at each of those levels that you can have a deeper dive in. So we have the state of the states. I won't load that page up. It's just a property clock page, which is live. This is the page I really want to focus on, is the local government area research assistant. This is each one of the 550 LGAs in the country. You've got some unique filters. So you can show me only LGAs that are between 8 and 10 o'clock on the property clock. So this is only showing you the local government areas that are potentially primed for growth now, and the market metrics and assessments are demonstrating that growth is more likely. You can filter based on state. So what I'm trying to do now is really get us in. We are looking at New South Wales. Are there any local government areas that are still showing good signs for growth in the next 1 to 3 years? That's what we're all talking about. This has now got us down to a far more manageable list. This looks to be about 30 LGAs here. As we go through this list, I mean, you might want to get your pen out and start writing them down, but a lot of LGAs in the Sydney area are jumping out to me, and I'm sure they're familiar to you as well, Edwin. You've got Bankstown, Blacktown, Burwood, Campbelltown, Canterbury, Fairfield, Holroyd. That's in Sydney, Western Suburbs. Correct me if I'm wrong there, Edwin.
That's correct.
Yeah, we've got Hurstville, Ku-ring-gai, Leichhardt, so that's an inner city suburb. Liverpool Liverpool, Penrith, Parramatta, Strathfield, Sutherland Shire, the Hills Shire, Waverley. They're the only ones that are jumping out to me. I did take the time, I suppose, to go through those individually, because there's one thing that's jumping out at me very strongly. So these are LGAs in New South Wales that are the optimum or still showing good signs of growth. And they all seem to be low to mid price points. So nothing really is above 650 as a median in these local government areas. It's just very low, especially for the Sydney areas, you all will know. Down here in Tassie, these are premium suburbs or price points, but these are all the lower tiered price points in Sydney. And these are, there's really no exceptions to that. You've got a high concentration of these lower to mid socio LGAs, all doing similar things, and these potentially are the alignment or the segment of the market that may, this is just the assumption, and this is me looking at things now with you, have the most steam left in the market. So it's an interesting insight. Any of those jumping out at you, Edwin, with what you're seeing on the ground?
I'm noticing some of these as you're going through the suburbs or the LGAs here.
Yes.
I noticed the median from the prices that are shown on the table there. I would imagine that them to be more apartments than freestanding.
Yeah. Probably that might be worth digging into a little bit deeper, because that's an average, or that's an average figure for the whole LGA. So you usually have that normalised, and that also might be another case in terms of you've had good growth in Sydney in the house market, and now you've got a lot of units that are sitting around. They haven't turned over. So the current on-market for sale price median for the LGA is what you see there, which is in some cases a lot lower than the sale price, because it might be the higher price points of the actual ones that are selling, but the on the ground median is what might have been sticking on the market for the last year or two. That may justify why the price is lower, if that makes sense.
Yeah, I can. It does. It does. And look, it's as I say to people, you can't look at the Sydney market with a broad brush approach, as your data set. Your data set clearly, shows very clearly, and that is, it's each LGA has its own suburbs. There's 41 LGAs. There's 670 suburbs in the greater metropolitan area of Sydney.
Yeah. And they're all potentially going in different directions at the same time.
Exactly. You can cross the street, and you could be 5 to 10% apart. And understanding the reasons why there's such a big difference in price when you just cross the street is is just one of those phenomenons, and you need people like yourself. You need data that captures all this information, because there's so much data out there. And what I'm seeing with your portal here, it makes it easier for the for the student, if I could use that term, the and educate themselves. Because I mean, I do this. I probably spend 2 to 3 hours looking at data from all over, from different sources, different websites, just to keep myself educated and keep myself my finger on the pulse, to understand the rental trends, the sales trends, and also with a understanding of why certain properties are valued a lot higher, and why suburbs are going up or not moving as quickly.
Yep.
I love your
that's
portal.
probably a good. It's probably a good point, because this is a page here. There's a lot going on behind the scenes, but it really just comes back to buyer behaviour in terms of what is a property clock. And a property clock is, if it's between 8 and 10 o'clock, then a property clock, you've had a bit of a recovery. There's been an alignment. People are doing similar things in similar ways in the mass. So the market is starting to gather pace, but that really just comes down to data and looking at that data. So you start to see yield. So rents has increased, yields have increased. As people are moving towards the area, they're pushing up rental demand and yields. Sales volumes are starting to occur and drive up. So you're having sales volume growth, and days on market are starting to contract because you've got sales, or you've got stock shortening or tightening. So that's a combination of those things is really just blended together into a property clock recommendation. So then as you see growth occurring, you start seeing yields dropping, and then that might push things more towards the top part of the property clock to 12 o'clock. You may see sales volumes start dropping because price is now at a higher point, so that might push the property clock through to 1 or 2 o'clock. So you can see really a property clock is just a really nice way of people understanding where a market is at. It all is just in terms of buyer behaviour. So I might just skip through this slide because this is a really good example of it. But probably the point I need to make is that a local government area could be doing one thing, but you need to find the individual suburbs in that local government area that are the absolute best representation of the upside and the positive. So it's about making sure you've got that interplay between the local government area, so that, say, the LGA of Blacktown, making sure you've got the suburb that is really driving Blacktown forward. It's not over in the doldrums. It's not left off the map. It's really the suburbs that are the heart and the soul of the growth. That's what it's all about. But I'm not talking about, so you're sort of talking about the data and bringing that all together. I just probably wanted to make the point that I'm just flicking back through the slides. I think I've taken off. I probably have made that point. That's how you generally see the data going in a common way. The buyer behaviour side toward, just think if there's a new train line or new shopping centre built, you've got new wholesale additions to the suburb, the utility that's offered to residents in that suburb. So people living there are now suddenly able to access the new, Moreton Bay is a really good case study that I use, because you've had a train line extension, a Westfields, an IKEA, a university, a business park, and now a marina. So you've got all these people that move into the area for employment, but then they typically usually rent first, and then they're pushing up rents because there's lots of them, and they're driving up rents, but price growth hasn't occurred yet. So yields are also going up at the same time. So that's one of the first signs that we look for of imminent growth, yields at a high point in the cycle and driven up. And then they start 6 months afterwards, they go, this is going really well, I love living here, let's buy. And they start buying in numbers. So you start seeing sales volumes going up. And then developers may be on the case, they might be putting stock in the market. If days on market is stable, it means that there's, or decreasing, it means that there's stock tightening. And that's when growth is really likely to occur. So it's a buyer behaviour backed analysis of the research, and it goes in a similar order. So that's all the property clock is at an LGA level, in terms of it's really just it's all backed on buyer behaviour. That's how we've formed our algorithms, but you've got to calculate it every day to be knowing the finger on the pulse and not be acting on old information. I think it's the key. I might skip back and forth. I have gone back and forth. I'm sorry, guys. This is the next point. If we wanted to use Blacktown as probably is that an LGA that you're familiar with, Edwin, and somewhere, or is another that?
Yes, I've got a level understanding of a lot of the suburbs, a lot of the LGAs in Sydney. We manage and sell property all over Sydney, so I do make it a point to try and get across it. But yeah, go ahead with Blacktown.
Yeah, let's do it, because now what we're doing so this page is helping us look and compare individual suburbs within Blacktown, and this is a visual mechanism, because I know the data can get, and then the research can get quite heavy. We try to develop a way of visually assessing the health of a suburb. So whilst Blacktown may be at 8 or 10 o'clock on the property clock as an LGA, you've got to find suburbs that are big and green and showing really nice, strong signs of health. So I might just break this down, because in the same way that you think of a property clock, you can look at the individual metrics at a suburb level. So the more metric alignment, so that buyer behaviour, you've got yields going upwards, sales volumes, days on market stable. The more of those that are in alignment, doing the right thing, the higher the metric score. So the higher that metric score, the better. You've got investor interest score here, which is Ripehouse users. We've got a really large amount of you guys now using the software, and seeing what you do and which suburbs you look at is really important. So the higher the investment score, the interest score, you may have more other investors within the platform looking at it, and which might typify the wider market. So you can have a little bit more comfort that there are people looking at that area now on a national level. So you can see here that Blacktown potentially has a low interest for investors using the platform compared to the whole country, if that makes sense. But then if you have too higher interest score, you might be coming up against a lot of interest and other investors making offers. Investability, so how many properties are on the market that are in demand and that are in the streets that people are demanding to live in. So more on that later. Income as yield, are yields strong, and are vacancy rates low? And opinion. So we monitor sentiment in the media and in expert sources. So we've actually done over 100 interviews last year with researchers, Real Estate Institute members, buyers agents, local property managers and valuers, to normalise sentiment, positive and negative sentiment for these suburbs, and we've got that across the whole country. So this is basically summarising it. Quite reasonable, average metric health, not much interest nationally. There's not a huge amount of positive sentiment from experts in the industry. So I think the storyline may have moved already from Sydney, and that's probably pretty consistent with what we're seeing. It doesn't mean that they're right. It just means that they've moved on because there's other low-hanging fruit to talk about. Investability is still strong, and income is strong in Blacktown. So you're still having strong and reasonably good yields and nice, accessible for rent turnover, low vacancies in Blacktown as a national level. But I guess probably the point is a lot of these are small and red. So we've got to be able to find an LGA, and we've got to be able to find individual suburbs within it. And I've digged around a little bit today in a lot of these LGAs, and you're not seeing that consistent story that you are in, say, the Moreton Bays or the Geelongs or other regional hotspots across the country, where you have really strong LGAs at 8 to 10, and then you've got a lot of suburbs in that LGA that are very strong and green. So the way around that is just think about it in this way. If we go across all of those LGAs that are looking pretty good, and there's might be 20 of them that are in Sydney, it's going to scrape through all of them, and we can click on the undercover button here. It's going to scrape through all of them and find the individual suburbs within those LGAs that are really leading the LGA forward. Okay, so this is going across the whole country, and is looking for that really nice fit where you've got LGA and suburbs that are doing awesome things, looking very positive. But we can also now I flipped it over, and I've gone a different direction. We can now do a New South Wales search and see if there's any suburbs that are jumping out of us in Sydney. Okay, so we've got Parramatta, Glenfield Park. No, I'm getting confused with Harris Park. Sorry. Bondi Junction, Rockdale, Cogra. That's Sydney, South Sydney. Edwin, is that right?
Yes, St George area.
Yep, and Rockdale, obviously in Sydney, Hornsby Shire. So this has flipped it up a little bit. So this is obviously, you can see a lot better, stronger market health in these suburbs. They're bigger and greener, really good investability, good income. So this is probably where I'd start in my investigation and research to try and find the best bits. One point I did, Malcolm Gunning, who used to be the RI Real Estate Institute New South Wales president up until last year, he's got a recent article on the Frontier Investor where he is talking about Bondi, looking really positive. And I can sort of comment that I have seen Bondi today in our investigations was looking quite strong, and also Bondi Junction. It's just in Bondi, we don't have much stock on market that is in those key streets. So the only stock that might be on market is sort of sitting around and getting a little bit stale and not really in demand. So it's interesting to get that storyline consistent all the way through, and that's what we sort of need to do.
Well, I think, can I just
go for it, mate? Absolutely.
Yeah, look, in relation to Bondi, and
Yes.
just going back to the data also that you were showing with regards to Blacktown, but in particular in relation to Bondi, we've just had a recent sale of a 1-bedroom apartment that needed to be renovated at $1 million.
Wow. Yep. I'm here in Tassie, mate, so the numbers are all quite funny to me.
Yeah, I mean, there isn't a lot there, but what is happening also in Bondi, I've been noticing, and in getting the data from the property portals, I extract the vacancy data from properties that are up for lease, in particularly apartments, and I've noticing have a continual increase over the last 8 weeks with properties for lease as new apartments and new dwellings are being finished, or high-rise developments.
Yep.
So you got a lot of distortion. So in relation to Blacktown is a little bit different. Blacktown, the developments come to a sudden halt with regards to the high-rise or multi-level apartment dwellings.
Yes.
And I think I personally I see there's a little bit. Obviously, I'm not a financial planner. I'm not a financial advisor here. I'm just giving you an overview of where some of our landlords have had some great success, and it's in some of these areas closer to the Parramatta LGA. I think the point that I want to make here is, Jacob, is that when you're looking at Sydney now, that we're getting some of these figures that are due to the low amount of properties on the market for sale. They're really skewing the numbers, and I'd say that once you pick this data up and put it through your methodology there, and put it through your matrix and all that, you'll see that in a month's time things will look totally a lot different, because there's so many things that are skewing the numbers, is what I'm trying to say.
Yes, yeah, and that's probably when you start seeing. So in really healthy markets, when there's growth, you've got a lot of demand, you've got a lot of turnover, you've obviously got a lot of sample size, you've got a lot of data there to make your representations. But as things start slowing down, you're obviously having lower sales volume, so you're having lower sample size, so things fluctuate in terms of your data analysis. So that is definitely a case and a key. Parramatta is one where you've still got 153 properties on market here. So each of these red icons is a property on the market, which is quite high. Obviously, there's quite a lot of dwellings in Parramatta as a suburb. But I have been monitoring and tracking Parramatta, where the numbers and the on-the-ground metric health has been strong since Christmas time, and it hasn't wavered. And if you can come back to the shape of the suburb, the metric health is not the problem, but it hasn't wavered, but the opinion has moved on. So the interest and the opinion, people have moved on to outside of Sydney, and they've gone to Queensland, or they've gone to Victoria, which is what our investor interest sort of trends have been happening at. Sydney's gone from about 40% of investor interest down to 25% in the last 4 months within Ripe House. So the storyline and people's eyeballs have moved in a different direction, but Parramatta is still very strong in the metric health side and hasn't really wavered. Probably the piece of the picture that is missing in terms of a lot of the bias is towards demand side metrics. And you might know, if there's a lot of supply coming into the market, and you know that that's going to be transacting or settling soon, that can really hammer vacancies within a week. It can change dramatically, as you just sort of made the point, Edwin. If you start, go for it.
Well, you're looking at the Parramatta postcode 2150,
Yes.
as opposed to the 2151, which is North Parramatta and the surrounding suburbs. You're getting 153 properties on the market. I can tell you now that 95 of those properties that are on the market are two-bedroom apartments.
Yeah. Yeah. And that
In the
might.
in the 2150 postcode, which is alarming. But yet, if you jump the border to 2151, which is North Parramatta, I would, I would. If my son was asking me, Dad, where should I put my money? Should it be in the 2150 pocket or the 2151?
Yes.
I'd grab his hand and I'd take him across Victoria Road and start looking for the older 70s, early 80s style apartments there that have got that I believe have got a little bit more room to go up.
Okay.
And they're very, very rentable, providing that they are they are updated, and that's part of the my talk tonight is obviously about maintaining the investment property to compete with the new. How do you set it apart from the new dwellings? And
So I suppose your point is, if you're renovating that property and having low maintenance associated with a good quality older property, you can compete in terms of the fit out. But is your point that you'll generally be able to acquire that property at a strong discount, and your value proposition is a lot stronger? And that's, I mean, a lot of growth is to do when value is there. That's when the growth occurs. So you sort of, is your point that there's a segment of the market which is the older stuff, that's positioned price-wise very attractively to the new stock.
I think so. That's very much
yeah.
that's very much the point, Jacob. And that's, if you look at any, if you look at from a property management point of view, a good property manager will assist the owner to maintain the property and to help them maintain in order to get the better tenant. In this case, we're going to be competing with close to 116,000 new apartments that are going to be completed in the next 12 to 24 months in Sydney alone. In the Parramatta, the 2150 postcode, there are 16 developments under construction right now, and 41 are in council for consideration for approval.
That's amazing, isn't it? So that's going to just put obviously a huge amount of stock into the market. It's a very particular type of stock. It's going to be a big chunk of properties that are the same. And so your argument is the opportunity is outside of that, going against that grain and really positioning good value properties.
When you start looking at the per square meter value. Let's look at that. Let's just look at it from a pragmatic point of view and just look at per square meter value in terms of outgoing costs as well, or ongoing costs. Where you've got high-rise apartments in Parramatta in the 2150 postcode that we have seen from a property management point of view jump from the strata levies jump from $900 a quarter to $2,200 per quarter, because of as I speak very openly about the construction issues that are facing Sydney. Not only Sydney, but also in other states that I've also read, but more so what I see happening in Sydney. So the value proposition in this, I put my two bobs worth on the Harris Park, North Parramatta side, the older dwellings. I think there's a bit of room there to move up, and they've got to move up when you're talking about $14,000 to $16,000 per square meter in the 2150 postcode in the new dwellings, and when you compare it to the older dwellings in the surrounding areas of less than $7,000 per square meter. There's got to be a meeting point, and I say there's going to be more of an upside there than there is there'll be a shift both ways, as my previous articles that I've shared with Ripe House. But I'd feel a lot safer with the older apartments in these areas.
It seems low variance. Probably that leads into another point, and this hasn't been scripted, by the way, because I see a lot of suburbs going through my screen every day, and they all blend into one, to be perfectly honest. So Harris Park is just a name to me, but I have seen that Harris Park has been very strong in the metrics, and it still is, and it's just tapered off a little bit. But when I do the street level analysis in a moment, exactly what you're saying. I won't give the game away now. It will make more sense if I just do a little bit of the teacher's hat again, because I can say that the data at a street level, so Ripe House is very powerful at the street level. The street level demand supply is favourably positioned for growth down in that 2-bedroom unit segment towards Harris Park, which you'll see in a moment, but it's very consistent with what you're saying in terms of that would be where the data is suggesting would have the highest growth occurring. So I'll just do a little bit of teacher stuff again. I'm sorry, just to try and clarify the methodology and why we do things. We want to try and find suburbs that are primed for growth now, not 6 months ago or 6 months in the future, but they are generally, we're talking about suburbs that are going to have a 3-year life in terms of above average growth. So we're not talking about a suburb that's going to be driving great growth for the next 25 years like the Mossmans. We're not talking about rural centres that may be very subjective to employment. We're talking about good growth stories that are staying to move from when you acquire, not in 6 months after you acquire, and they're usually about a 3-month life run with above average growth. That's what we're just trying to define the outcome. We call it hockey stick growth. If we can see a market hasn't done anything for 10 years, we want to put ourselves one day before the growth starts occurring. It generally, whenever you've got markets, you've got lots of different pulls in different directions, and it sometimes takes quite a while to get all of that consistently moving in the same direction, but when it happens, things really take off. So it's a very consistent growth story, no matter what you're tracking. I might skip through this slide. I want to try and make sure, and I think the point's probably been made quite quickly, that you're all understanding what we're meaning by this type of growth, and maybe just jump on the chat. Is it something that this type of growth that you're interested in, or you're more concerned about longer term growth, or you understand how important it is, I suppose, to potentially put yourself in the optimum buying opportunity. So the longer you're holding an asset without having growth, you've lost opportunity to obviously be investing in other things. So this is just a chart here of aggregate growth. I won't say which suburb market, city market it is, but it's just going to throw us off the scent. But whereabouts on this timeline would probably be the optimum buying opportunity for you? Do you think it would be right in 1980 and have that holding cost without things not really doing anything? 1995, things start trending upwards, but they really don't start moving until 1998. So 1998 to 2000, you've had an amazing growth period in this market. When do you think would be the time that you would prefer to buy in that line? Everyone, have you got any ideas there, mate?
I'd be closer to the actual peak personally, because there's a lot to take into consideration. Obviously, how long can you hold? Is it in terms of dollar for $1,000 value, or the old rule of thumb? At the moment, if you look at the numbers in general across Sydney, nothing makes sense from an investment point of view if you're going to look at rental yields. But there's a lot more to it, as you mentioned earlier on, and as your data captures as well. It's not just the one aspect; it's many aspects of the property market that determines whether or not it's a good investment, an average investment, a great investment, or a U-Butte. I wish I had 10 of these every year type of investment. It's very significant. So it comes back to also the individual, how they're positioned, obviously financially. But just to simplify it, and again from my point of view, and not subscribing to my father's comments in 1976 when he was offered 10,000 square meters of land at Emu Plains for $1 a square meter. His famous words were, who the hell would want to go and live in Emu Plains? So I'm not a subscriber to that. But I am a subscriber to is that, if you can hold property for a long period of time, it will go up. But it comes back to the individual need, and I guess that's why you're on you've got this this webinar. You've got the tools that you're giving your students, your subscribers, the information that's on the ground that people can email me, contact me, and just ask me as a friend of Ripe House. Happy to share a lot of this information with you
Beautiful.
guys.
Yep.
But going back is make sure whatever property it is that you get to hold for a year, 2 years, 5 years, 10 years, you get a great property management team behind you to help you in a journey, and that's paramount.
The journey.
Yeah, and that's absolutely paramount. Those relationships that have been built.
Yep. No, it's a very good point. I guess in terms of I was trying to probably simplify things a little bit too far, but just to try and get people thinking that, the time in the market, you obviously got great returns when you look at the longer periods of time, but you really want to position yourself to get that growth from day one, because that growth gives you a lot of power. You can sell the property and obviously get the return, or you can refinance and flip into another property. It's giving you power. So it's around there's been a few of it that said 95, 2000, but obviously the lion's share is 1998. So just positioning yourself there for when things are really starting to move. And that's not really talking about the land banking or the scarcity type strategies with the Bondis of the world that will always go up because you've got a scarce driver like the beach as an example. So this is talking about areas that are really moving through a growth phase for whatever reason at the time, and that usually happens in the same sort of way. It's the same rollout. I just wanted to make a quick example, because what we're talking about now is how people use the Ripe House software to do research in an LGA into a suburb, into a street, into a property. It's really important to get that street and the property right. As you'll see in a moment, there's a lot of different things going on in Parramatta at the moment. It's a very particular class of property. Everyone's sort of noted, and I'll dig deeper into it, that might be able to deliver the greatest growth figures. Jump onto the Frontier Investor. There's case studies on there around Guy Williams, who's a Ripe House subscriber and user. He's bought 10 properties in the first 10 months of access on Ripe House, and the average capital growth, annualized capital growth for each of those properties was 25% each property, 105% cash on cash returns, and 6.25% yield in 10 months. He's an expert. He's very good at negotiating. So that's a little bit of cream that he adds to that pie. But it's all about getting that LGA into suburb, into street, into property, and you're amplifying results. And he's able to consistently been able to deliver 25% average growth per property per year. Check out that full case study in the Frontier Investor, because we detail all the properties, where they're located, exactly how he does it. And he's got a lot of tips on there about how to manage large portfolios, how to get finance, how to structure. Some really good tips on that. But it's just a little bit of insight into how people might get benefit or usage from Ripe House. I won't go into the Frontier Investor, because I did want to. I've gone through this in terms of the hockey stick growth drivers, the buyer behaviour, how things transfer through tenant demand into sales volumes, into growth. But I just wanted to clarify how to get the street level research right, because he's definitely, and for locals of Parramatta, there may be areas that just know to be avoided, that areas that are just not moving forward. We want to focus on the streets that are really driving growth forward and be the #1 candidate for growth. So how can we do that? We have a unique database at Ripe House of been tracking, like Google does, on-market history, so for sale, for rent and sold listings for 5 years. We also know levels of public housing, tenants versus owner-occupiers, houses versus units, higher rents, higher yields per street. So not per suburb, per street. And we've been able to find 5 unique factors, when combined, can deliver 21.9% above average capital growth for that street compared to the suburb. So if the suburb goes ahead 4%, if you invest in the correct streets, you could expect potentially 5% or up to 5% growth at the same time. What that means in the Sydney market for the next 10 years, on an average property, on average projections, potentially $240,000 more growth just by getting that street level right. This is the last point I make before we can go in and have a really nice deep dive in Parramatta, but the 5 secret sauce of the sweet spot is low public housing, under 15%, lots of the in-demand property types, so lots of, you're hitting the market, you're not focusing on 1-bedroom units when everyone wants 3-bedroom houses. That street is a focal point for the in-demand property type, and strong tenant, and so good above average rents, above average yields, and good strong tenant demand above 33% tenants. That's the sweet spot. We have, bring that all together. It's usually only about 10 to 15% of each suburb. Some suburbs don't have a sweet spot. But as I say, 21.9% relative growth above and beyond. All of those things I just mentioned, you can actually visually see them on the map. So you can see the red areas here of public housing. So quite a strong public housing enclave up here towards the river, towards the uni. Also public housing here near the Ollie Webb Reserve. You can sort of connect all the dots and try and remember where all these things are. So the darker the purple here, the higher the rent. The stronger the yellow, the higher the yield. Nice strong yield area through here towards the south area of the train line down towards Harris Park. That's a big hint, everyone, in terms of where we're potentially focusing. But you can see this is an incredibly powerful page to understand the suburb. You can do a lot of your vacancy rate comparisons that you mentioned there, Edwin. So the suburb in question is quite low in vacancy rates compared to Maze Hill, which has very high vacancy rates. So you can see vacancies suburb versus suburb, or a lot of the metrics there. But I want to focus on the sweet spots in Parramatta. Let's make our job easy. This is the interface. You can do that. You can click on the capital gains badge to show us those sweet spots. It's going to show us 4 street areas that really tick all the boxes. And you've got one very strong sweet spot zone down towards Harris Park, which looks very attractive. Also a couple of spots up here towards the Western Sydney Uni. And then another very small isolated area here towards the theatres. But I can also make the point that over in Harris Park, you've also got strong sweet spots on the opposite side of the border. So this story is reiterated in Harris Park. The sweet spots, the really nice areas of demand leading to future growth or likely growth, are directly opposite on the opposite side of the border. Does that make sense for you, Edwin, in terms of how that street level stuff works, and is that consistent with what you're seeing there?
Yeah, very much so. The only thing that would add further value to your data
Yes.
is the LEP changes, or changes to the to the local to the LGAs, the planning regulations, the changes. So where you've got they're paramount, because you could, what you'll see is also the state government planning regulations that are yet not gazetted, but and that's how as people get to know yourself, and as we continue to build a relationship, we can give your subscribers some insight into where certain areas are going to skyrocket in terms of with the changes, future changes.
Yep.
Planning, which is,
we don't generally have that advice built into the software, only because it's sometimes quite subjective. But if you've definitely got any questions, we do maintain a Rolodex, I suppose, of other users who are doing similar things. And if they're happy to share information, we're happy to share it with you as well. But in terms of, definitely zoning changes and changes in that zoning, we usually dig a little bit deeper into any of the suburbs or LGAs that we have the strongest potential for. We join them together into a report every month, which in most cases is about 50 to 100 pages, where we drill down into the exact streets and we investigate a lot of the whys. So Geelong is one where you've got some suburbs down there that are doing great things capital growth-wise. The policy is that they're not really rolling out public housing, which is needed. They're putting that back onto the investor, so they're just having open slather zoning approvals for any block size. We know the whys. If you reach out, we're happy to share our understanding, and definitely, obviously, forward the inquiries or thoughts through to you and your office to give that local touch, because the whys are really important to give that story to the data. But you can see it's really quick. It's got down to 17 properties that are on the market. You can see the listing history, so how long the properties have been on the market, days on market, if any have been discounted. So one of them here's been discounted 3% in its sales activity. You can click on the URL, view the individual. So this is probably a 1980s block. Would you say 1990s? Probably mid 90s.
Late 90s.
Late 90s.
From the face brick, could even be from the rent. It actually looks like part of the SEP 65 that Bob Carr introduced in the late 90s, early 2000s, when he decided to bring colour into the new developments. Therefore, asked the developers to render the fascia, and we ended up with a quite big mess of maintenance issues thereafter. But yeah, so I'd say it's late 90s, probably 2000.
With what you were saying around the 70s type stuff really hitting the market, is this equally applicable, or are you still probably paying overs for this, even though it's sort of in the middle ground in terms of age?
Can you repeat that question again?
So are you seeing the same, when you're making your focal point, the 1970s blocks, because you can get them for that really low price point, you've got that bigger differential to the new stuff. How does this sort of 1990s or early 2000 type stock, is that in the middle ground? Is it you're not really getting the bang for your buck, the value there? Is it closer to the new type property value, or is it more towards the 70s?
Okay, from a management point of view, there's less maintenance in terms of there's less strata fees that will be paid out. There's less maintenance of the actual block from a strata management point of view. The new apartment blocks that are being built now, the high rise, you've got a lot more issues to deal with from a strata management point of view, which also impacts the property management side of things, because there's a lot of confusion with regards to who's at fault when things go wrong. Unfortunately, because that's just the nature of that beast. So these apartment blocks are still very manageable. They give you very good living spaces and bedroom sizes, with the majority of them having the balconies are generally double the size of what's being built now. Just to give you a general overview, the average living space for apartments that are being built at the moment are internal living spaces is around 70 square meters. Whereas in the apartments that you're showing in the mid to late 90s, early 2000s, they average about 92 square meters internally, living spaces, not including garages. So that's what. So from a tenancy point of view, they rent really well. You've just got to learn to to keep up with the maintenance. Get rid of the old carpets, give it a lick of paint, look at replacing perhaps the cabinetry work in the kitchen and the bathrooms. Just update a few cosmetic cosmetic changes.
This property seems to have had a nice freshen up in the kitchen, bathroom. This is not our property, by the way, guys. This has just come out organically in the process. But what I probably just did there while you were talking, Edwin, just to clarify, and I'm trying to sort of layer what we're doing. It's gone away and found comparables. One of the comparables stood out to me in terms of it was 460. I opened it up. It was a 1970s unrenovated kitchen, which is inferior to what we're looking at. I've lined up 5 comparables now, which are within 20k of each other. They do all seem to be very similar. You've got a lot of. So this is probably 1970s fully renovated. Quite similar. All I'm doing is just assessing, is it relatively comparable in terms of condition, location, block size, etc. These all seem to be quite tight, quite similar. getting quite confident in terms of the appraisal. I do think it's necessary to own this process of appraisals. You can do all of this within Ripehouse, but if you just leave it to its own devices and it's automated, you can't use that to negotiate in terms of using your comparables to negotiate, but you may be off the scent. So automated appraisals, I don't usually. I prefer to have the investor own that process, but we have some unique algorithms that weight and appraise value based on the location and how close the shopper's schools, transport and shopping is, and obviously if it's strong public housing. It's an end-to-end in terms of being able to do that, but I think in terms of getting that property right and appraising it and then using those comparables to potentially negotiate under market or have an attractive negotiation process. But probably the point is what we're looking for, and what has come out of this evening is we've found a very specific segment of the market that has potentially got the most upside in Parramatta, and that's 2-bedroom, 1970s, or older style apartments that have, I think you touched on it, high yields, and that may be the key. You can get into these properties, lower purchase price compared to the new stuff, but they're renting for a commoditized type of rent. So there's not as much differential between the rent and the price. So the yields are higher. And if you can remember back to this is one of the strongest yielding street areas in the suburb down here. That may be the data cutting through and giving us a little bit of insight into what might be happening. And that's this sort of spot down here. So I'm just trying to take you through. You probably all might have been frantically writing that address down and going to call that agent tomorrow. But in terms of it might not be right for you, the appraisals probably might spend a little bit more time in getting those more confident. But I just wanted to show you that process of how we got to that absolute top of the mountain. Across the whole of Sydney, how we can focus in on exact streets and property types that really are driving growth forward for us. That's what it's all about. I might try and get through to the question and answer session, Edwin, if that's all right. I'm just aware of time. These slides, I'm sorry, I probably just went into that in summary in reference to the map page there. I just probably want to say a big thank you before we go into the Q&A, just for coming along tonight, and I'll thank you personally, Edwin, at the Q&A session, but just probably for the users to take the time out. And I love talking with investors and helping and working with investors. It really is something I'm passionate about and I enjoy. And for you to sort of hang around and take time out of your night to learn and to work together with us in learning, thank you. And I'm pretty excited. And yeah, if you've stuck around, you're obviously in a similar sort of fashion. And I think what you've seen, if it is of use, it sounds like it is. I'd love to extend a big thank you towards you. In doing so, Ripehouse is a subscription service, so it's usually $1,597 per annum as a subscription. As a big thank you for coming together and joining us, I'd love to offer a $400 saving on that amount, bring it down to $1,197. That includes open keys. Everything you've seen tonight in terms of the research, access to content. We have private webcast events, private content, but we also have monthly reports which come out. They're your cheat sheet. They are all included in terms of the subscription, because we have to give you everything to make sure you're comfortable and you're empowered to be able to use the research and the data to make decisions. It all comes down to making decisions. So that's why we support it with everything you've seen plus research. It's all inclusive. I'd love to, just clarify, we do have the private individual events for subscribers only. They're intermittent and they are really high value. So it's all creating this community of value to help you make decisions. Over $1,800 in bonus value. A lot of other people in the industry use Ripehouse for certain ways, in certain ways, a lot of familiar names. A lot of our users do things in different spaces within property, but a lot of investors use Ripehouse to really give them the confidence to make purchase decisions and being able to really position themselves in front of that growth. But to jump over, before we jump into the Q&A, more than welcome to jump over to www.ripehouse.com.au/bonus. You are able to click on the green Get Started button. That will lock in that special thank you offer. Entering your basic details. Your secure credit card details are processed by Stripe. That's directly with Stripe. That will then activate your account. You'll receive a welcome email, access to the reports, all of our learning modules in our learning centre, private research and tutorials. It's all there. Would love to get you involved. Big thank you. I did want to probably make the point, it's not on that slide, that is only available until midnight tonight. Then we shut the doors on that offer. It is only available to us to join together as a group tonight and access that rate. So that will be closing down at midnight. That's on the bonus page. We'll display that. So whilst that's all occurring, you can go and do that now. I might put things on mute for a couple of minutes while we just gather some questions, Edwin, but a huge thank you for taking the time out and coming along tonight and providing. It's a great conversation. I've got a lot out of it personally, and I hope you all have as well. If you've got any feedback, positive or improvements, please let us know in chat. I'd love to give Edwin a big thank you and that positive feedback. You've got Edwin. So Edwin is Just Think Real Estate. Edwin Almeida's managing partner. That's the contact number for his office there, 0296356277. If you'd like to talk to Edwin directly, I don't want to put his email address and mobile on the internet. Just flick me through in the chat bar now an email, the return email for any of the webcast emails, and I'll be connect you with Edwin. So Edwin's core business is sales, but also property management. So he has a unique perspective in terms of really adding value to, as you've seen tonight, hitting the market. So helping investors make sure they're focusing on the property that is really going to help and deliver reliable tenancies with good rental demand and ongoing. And that's how we've come to know each other, and obviously providing great value to investors through the Frontier Investor already. Thank you so much for joining us, Edwin. It's much appreciated.
Thank you for inviting me, and thank you, listeners, for listening to me rant on about property.
If you don't want to stick around for Q&A, thank you for joining us. I hope you've got something out of it. I'll put the mute button on now. We'll be back in a minute or so with some question and answers. Thank you. Okay, let's jump into it. We've got a few questions, but I'm also aware of time. So quite a few of the questions are quite subjective in terms of what you're trying to do personally and how you're trying to do it. So I might hang around on the line afterwards and I'll chat with those and answer those questions directly with you in the chat bar. First probably question is from Mary. What is your view of South Penrith for capital growth? Probably go to you first there, Edwin, on that. Are you seeing any sort of good infrastructure projects or reasons why that particular area might be going ahead?
South Penn, again, it comes back to the style of property. What are you looking at? Are you looking at a townhouse, villa, freestanding, new, old? But so overall, in general, what I have noticed is Glenmore Park, South Penrith, steadily on the rise. I don't know what your figures show, Jacob, but I have seen it. The freestanding homes particularly increasing value. So, in terms of,
I haven't seen it jump out at me on a national level. In terms of, it might be worth taking this offline with Mary and just working through the software with her to find individual suburbs. Just because your point's equally, it's always applicable in terms of you've got to hit the market right with the in-demand property type in the sweet spots, in the streets, the suburbs that are really driving growth. So I probably just, if you had any observations generally around the LGA or certain elements that might be causing it, but it hasn't jumped down at a national level. Uh,
There's a fair bit of infrastructure going on in there. There's development with UWS, the University of Western Sydney. You've got
yes.
look, there are a lot of positives. There are a lot of
Okay.
positives
Yep.
for that area, but like yourself, nothing there jumps out at me either in terms of, wow, I got to call my I got to call my mate and tell him to bring the checkbook sort of stuff.
Beautiful. Gunnar wants just asked a question about Ripehouse. How is your system different with, say, someone like RP Data or any of the other systems out there? What we try and do, so we do, it has to be clarified, we do own all of our own data sets, so we control that because we are able to do amazing things with it. If we're able to be flexible and we're able to pivot and do, and we're really trying to all the time innovate in providing outcomes to make help people invest and make decisions. So we try and look at the data and make predictions based on where it is at the moment, not just trying to clarify the current state of affairs, but really trying to look forward. So we're not looking at the past. We are not just looking at the current. We are looking at how the unique relationship between the numbers and metrics relates to buyer behaviour and potential for growth. So that's how we're different. We've got a forward-facing outlook, and the software and research and recommendations are all based on looking forwards, if that makes sense. But we've had another few questions around individual suburbs. They weren't really on the list that we've spoken about tonight. It might be worth pulling them out. Gunnar was just talking about eastern suburbs, and I've probably got a point to make on that in terms of you've got different drivers. So a lot of the Bondis of the world, you've got drivers around, they may outperform, they may have above average growth every year for 25 years, but they never really stand out in terms of being the absolute top performers. They're the slow, steady growth stories based on different growth drivers. So you might have Parramatta, you might have the Penrith, you've got big population pressures, you've got new infrastructure going in, you may have outstanding growth for 3 or 5 years, and then that's all priced in and it just falls back in line with a middle market.
Jacob, in relation to what you're just saying and the question that's been asked about the eastern suburbs,
Yes.
I commented on or wrote a couple of articles and commented on the domain, and also was quoted by the Sydney Morning Herald and Australian Financial Review with my predictions with Millers Point.
Yes.
I said to the general public and a good friend of mine, Jennifer Duke, that also is an avid property writer.
Yes.
We spoke about, and I mentioned to her about what was going to happen in Millers Point with regards to the housing there, and how it was going to be undersold, and how the people that would buy there early in the piece, that were going to make a lot of money in a short period of time. And that was true. And this is what I'm trying to say, is that myself being a friend of Ripehouse and your friend, and
Yes.
willing to help your subscribers, is that we can identify a lot of different things, and with the assistance of the information that you provide through your services here, I think it's a great, you've got great tools that differ a lot from RP Data and the like, given the fact that you can predict where things are going to change and why. And like myself and a lot of the other subscribers to the other people that are noted that are associated with Ripehouse, we can assist your readers and your subscribers to determine and help them determine the changes and the patterns. We've spoken off the air as to,
and have the human story behind it. It's
yeah,
very important.
and that's what's required. Now, I'm sure you've got the same relationships in other states, in other cities, and I think that's answering both the first question about how does your data differ, and also answering the question of how are the eastern suburbs. I mean, right now you give me we start talking about the $1 million mark, I can name quite a number of sub places and streets and the like that we've discussed with your data that would pinpoint great opportunities for people. But it comes back to what I think what I've seen that you put together, and you guys have got there, is that synergy between the live data and real people on the ground at street level to help and assist with valuable information that's going to carry a lot of.
I think it's invaluable, Edwin. It's extremely important, and it's. I think it's for everyone to sort of come on and give that sort of insight, but then also, you know, the level of detail and due diligence that you go through in property management, I think, is second to none. So that's why we're talking. You know, I can see the customer focus and in everything we've sort of spoken about. So I feel very comfortable in having you on and providing the insights. I hope. There's a few other questions I might stick around and answer individually, just very subjective, so it's worth just answering them in one-on-one. If you've got any further questions, if you'd like to funnel them through me to Edwin, obviously I don't want to open up the email address online. I think that's probably not good, but you've got the office number there for Just Think Real Estate, and Edwin Almeida as the managing partner licensee in charge. Thank you so much for coming on, Edwin. We've got lots of positive feedback. If you've got any more, please send it through. Any feedback at all, it'll be great to hear. But I really appreciate you coming in and joining us, and hope everyone's got a lot out of it.
Thank you for having me. And I've got to say good night. I've got to get back to my own research now for further articles, and
beautiful.
A warm cup of tea in a wet Thursday night. Sydney.
It's pretty miserable down here as well, mate. I think I'll do the same. Thank you, everybody.
Right, on that note, good night.
Thank you.